Hello, everyone, and welcome to another episode of Refinitiv Perspectives Live. Today, we will be talking about the 2021 Russell Reconstitution. The Russell US indexes are designed to reflect the ever-changing US equity market, and the annual reconstitution process is very critical to maintaining accurate representation. So for today's topic, we have two guests joining us to discuss exactly that, who are Catherine Yoshimoto, FTSE Russell Director of Product Management, and also Bob Hum, US Head of Factor ETFs. Welcome to both of you for this Refinitiv Perspectives Live. Thank you for joining us.
Thanks for having us.
Thanks for having us.
Probably I can start with you, Catherine, as our first guest. Maybe you can tell us a little bit about the Russell US family, let's say, of indexes.
Yeah, the Russell US Index Series is a modular set of benchmarks representing the US equity markets. They were actually launched with the Russell 1000, 2000, 3000 indexes back in 1984. And they've been enhanced over time with the launch of additionally the growth and value indexes in 1987. And then, further derivations now exist, including ESG and factor indexes. And as you mentioned, the annual reconstitution is a very important part of ensuring the benchmarks continue to accurately represent the segments they are intended to represent. And we began reconstituting the indexes annually. Initially, they were reconstituted quarterly, then semi-annually. And then this year was our 33rd reconstitution, which concluded last Friday, June 25th.
Maybe we can go, a little bit further into details. What exactly is the Russell Reconstitution and how does it really work? I believe many of our audience probably don't know too much of the details about that. Maybe you can explain further.
Sure. The Russell Reconstitution begins every year with the March announcements. Every year at the beginning of March, we make any methodology announcements for the year. This year, there were really just clarifications, no change in methodology. We confirmed the announcement schedule and dates. This year's rank day was May 7th. So this was the date that companies' data was used to reconstruct the indexes. So essentially, reconstitution is a reset of the Russell US indexes. May 7th is the data as of date that we use. June 4th was our first announcement date, in that the market and clients first got insight into the additions and deletions into the indexes. There was a week of a query period. Then there was, basically we entered a period called lockdown once the changes were confirmed for this year's reconstitution. And then the reconstitution again is final on June 25th. So, it is part of our transparent process, rules-based process. We want to ensure we're giving the market enough time to react to some of the upcoming changes so that they are prepared for June 25th. We like Russell Reconstitution to be an orderly event. It tends to be a very high volume event. This year, actually, NASDAQ broke the record with, I believe it was, I have it right here, $80.9 billion executed in the closing cross in 1.97 seconds of NASDAQ listed securities, compared to 56.7 billion in 1.46 seconds last year in 2020. So as you can see, it's a high volume event. This doesn't include the NYSE traded securities amount. But last year, if you include NYSE securities, it was over $100 billion traded at the close last year. So you can see it is a very highly anticipated event. And that's why we also want to make sure it's an orderly event so that the market has enough time to prepare for it.
Maybe to Bob, how do you use the reconstruction? Is it something that you're looking out for?
Yeah, absolutely, Shahad. And so when thinking about the reconstitution and thinking about indexes in general, I think the beauty of it is the transparency, right? And so our clients are coming to us asking, what are the changes? How is it going to differentiate our exposures in our portfolios? And one thing, leading our factor business here, I think the question we often get is, how is this going to affect my portfolio at the aggregate factor exposure level, and what are the changes to it? And so, I think again, the beauty of these indexes is that they are transparent, right? Oftentimes, historically, our clients would be using active managers, and you wouldn't know on a quarter by quarter basis what's underneath the hood. I think the beauty here is that we actually can telegraph what those changes might look like, and then you'll know exactly what you own within your portfolio, in record time, honestly, right after the reconstitution.
And what are some of the highlights, let's say, and the changes at this year's reconstitution?
Yeah, certainly. This year was an exciting reconstitution. I mean, of course, last year was exciting in a different way. Last year, last June was shortly after the COVID pandemic began. There was lots of volatility in the markets. And so last year's reconstitution was a story of the bigger companies getting bigger, but also the smaller companies got smaller last year. The smallest company in the Russell 2000, which is often, tracked in terms of, what's the smallest company in the small cap index, that dropped to below 100 million for the first time in a decade in 2020. So as you can see, it reflects how the markets were reacting in a very volatile manner last year to the uncertainty around the markets. However, this year, it was certainly a change in terms of the story was really one of recovery across the board. So last year, there were 3 companies above $1 trillion in total market cap. This year, there were 4 companies above $1 trillion in total market cap. The closely watched breakpoint between the large cap Russell 1000 and small cap Russell 2000 indexes increased from 3 billion to 5.2 billion. And then the smallest company in the Russell 2000 increased more than doubled in size to 257 million. And overall, the total market cap of the Russell 3000 altogether increased more than 50%. So as you can see, it was a story of recovery. The Russell Reconstitution 2021 was telling the story of recovery compared to 2020.
Yeah, and Shahad, if I would just jump in there, I think the other story that we've seen just in markets in general really is this bifurcation between what we would call the reopening winners and the social distancing winners, right? So think of the social distancing winners as the stocks that did really well last year because we were in lockdown. So I don't know, if you think about my personal life, we have a 1-year-old. All we do is we shop on Amazon for diapers. Sometimes we binge Netflix. That's our new kind of date night. And I'm on Zoom calls all day. You look at those stocks, those companies like Zoom was up over 400% last year. And then what changed in the market, I think, was on November 9th, Pfizer announced the vaccination and the 90% plus recovery rate. And so what I think that did is it changed from the dynamic of a lot of these healthcare names and a lot of these social distancing winners and the technology names to these reopening winners, right? What are the things that you wanted to do when the economy recovers? You want to travel, you want to go to hotels, you look at one of the biggest names that entered the Russell 1000, Caesars, is up 76%. Since November 9th, as of yesterday's close. Why? Because people want to go out and go to casinos and gamble. I don't recommend that, but I would just say that's what people want to do. And so I think that, and so that's what a lot of the changes were. So if you think about what's entered into the value index, it's a lot of healthcare names, right? What's entered into maybe the larger cap names are some of these reopening winners like Caesars. And so I think that was a big trend and theme that we saw across the Russell indexes, whether that's the cap weighted exposures as well as maybe some of the factor products that we run here.
I mean, you've mentioned trends. We've talked about the highlights and changes. Maybe to come back to those changes real quick. But Catherine, how do you ensure everything goes smoothly? How do you make sure that everything runs as planned?
Yeah, I mentioned earlier the transparency and the scheduled communication that we provide to clients in the market. That is a critical part of how Russell Reconstitution runs smoothly. Of course, we have our, in case exchanges go down, the trading halts policy that is published. So, we would operate according to the published policy if there are any disruptions in the market. However, we have been through, in the past, disruptive markets around the Reconstitution event. For example, Brexit occurred right around the same time as Russell Reconstitution several years back, and we operated through that seamlessly. And then I also mentioned the NASDAQ closing cross. This year was the 18th year of the closing cross. What happens is that in the final seconds of trading on that Reconstitution Day, NASDAQ essentially ensures that there is a single price, so a primary exchange price, so that, you know, they're reducing some of that volatility at the close, and NYSE has its auction process. So as you can see, there's a lot of processes that have been established over time, and communication to the markets into the upcoming changes, a really important part of making sure that process goes smoothly every year.
And maybe in the direction of Bob, what are you seeing from clients in this space?
Yeah, sure. So, you know, as I mentioned previously, right, from an investment theme perspective, it has been truly this work from home versus the reopening winners. And if you think about it from a factor lens, you could actually map that over to what is the reopening winners? They're value stocks, right? They're stocks that were the most beaten up, the most underloved companies of last year. And that has been far and away the biggest theme in client portfolios. I think for the big reason why is that value has been so poorly performing over the last few years, right? Value stocks, if you look over the last 100 years, are in the worst drawdown in history. So since really the start of 2017. And so what that's meant is that most client portfolios are significantly underweight value. You know, we did, I think, over 30,000 advisor portfolio analyses last year, and you know, over 60% of the portfolios were underweight value. And so I think what we've seen from an investment lens perspective is the shift to value across capital flows, right? So the first quarter of this year has been the best quarter on record for value ETF flows. Just in the large cap space, it eclipsed over $20 billion. And I think the big reason why, again, is because of that reopening trade that happened on November 9th. If you look at value indexes today, whether it's things like the Russell 1000 values, up 30% since the reopening on November 9th, compared to growth that are up about 18%. And then I think what's really interesting is that now, because of the product innovation with FTSE and with BlackRock, you can actually take that a step further in some of the maybe more focused factor-based value products, you know, FOVL or SVAL, our small cap value. Those are up over 60%. Since that November 9th. And so I think what we've seen from an investment perspective, it is the proliferation of value and the increased flows, and then really the optionality to dependent on their views on the market, use different types of value exposures, whether it's the Russell 1000 value or maybe factor-based products, more concentrated products like FOVL or SVAL.
Catherine, maybe do you want to add to Bob's answer? Have you seen similar things whilst working on the Reconstitution this year?
Yeah, I was going to actually add, you know, to Bob's point about the values comeback. I mean, we really did see that toward the end of last year, values recovery as well as small cap. As Bob had pointed out, growth had been taking in the lead for quite a while, over the past several years at least. So, you know, it was an interesting turning point for value in small and micro cap stocks. We also actually have a micro cap index. So if you look at the performance of, you know, the large cap versus the small cap versus the micro cap indexes over the year, you know, ending in May or June, you can see that micro caps really recovered compared to small caps and then large caps. So, you know, it really was a turnaround year for value and small cap stocks.
Also, Bob, sorry, you wanted to say something?
Yeah, the only other thing that I would say, the questions that we're starting to get, and what's kind of interesting over the last few years, is really people wanting to look under the hood of their products, right? Especially with, and I don't want this to derail the conversation, but with the rise of the meme stocks, people are asking us, pretty much on a daily basis, what is your exposure to GameStop? What is your exposure to AMC? And what's interesting is that dependent on your index, and for example, the Russell 2000 value versus the Russell 2000 focused value, you might have GameStop and AMC as two of your top holdings. Now that's changed because of the Reconstitution, versus SVAL has zero exposure to those names, right? Because it has a quality filter. And so I think what we've seen over the last few years is that because there's so much idiosyncratic risk out there on certain individual stocks, I think people are starting to look at how are these indexes constructed, because it's not that to say that you shouldn't own AMC or GameStop, but I think based on the index that you're choosing, you may own that stock or you may not. And so I think that has been a big change within the industry. No longer are people just indiscriminately buying indexes or ETFs. I think they're really doing their due diligence, which is critical based on how many products are out there in the market, and how they cut the universe is really important, and it will dictate the exposure that you have in your portfolio.
Yeah, Memestock mania this year was a new and hot topic. I have to say, we received a lot of questions around the changes from the public around the meme stocks. I think I've read studies that during the COVID crisis, there was this explosion of day traders, and initially they were focused on single stocks and trying to make a profit on these single stocks. And now I think it's evolved a little bit. They've had maybe a year experience under their belt. So they're starting to realize the beauty of the index products that can offer them more diversified coverage, not just exposure to like a few single stocks, but to give them exposure to the large cap segment or small cap segment or growth or value segments.
Yeah, I think for the first time ever, my family cares about what I do for a living. So that's also been a positive with these GameStop and AMC news. So I'm pretty happy about it on that front.
Yeah, I couldn't agree more.
I also believe that more and more people are really getting a feel or a better understanding, because there's so much information out there that really explains exactly these things in a much more easy way, and a much more accessible way for everyone who has not anything to do with finance, which is also good. I have had one other question regarding the transparency, because when we are talking about changes and anything new, what role does transparency play in that Russell Reconstitution process?
Yeah, going back to the schedule, the methodology announcements are made in advance. For the annual reconstitution process, the March 1st date is generally the announcement for the June cycle. And then we also do make sure that the market is informed of the upcoming changes. I mentioned the additions and deletions to the Russell 3000 and Russell microcap indexes are posted to the FTSERussell.com website on that first announcement date on Friday, which was June 4th this year. So we do communicate, weeks in advance, leading up to that June 25th date. So the market has enough time to react and provide feedback, and we have a quality control process. And then, it's really important that we make sure that reconstitution is an accurate reflection each year, because it is essentially the one chance that, stocks can be added or deleted in one fell swoop. We do have quarterly stock additions with the IPO additions process with our quarterly reviews in September, December, March, as well as share changes and float updates. But annual reconstitution is really the chance for all eligible companies to be re-ranked, and the index is reset each year. So this year was, I'm not sure, we haven't really touched upon this during this conversation yet, but this year was a big year for the de-SPACs and companies coming out of bankruptcy, being able to rejoin the indexes on a net basis. If you include the Russell 3000 plus microcap stocks, we have an index called the Russell 3000 E index. The E stands for extended. So this entire the broadest Russell US index we have, on a net basis, added more than 450 stocks at this year's reconstitution. I counted net additions of 466 stocks. So the E index which includes up to 4,000 stocks. Hadn't even broken 3,500 stocks over the past several years. Actually, included more than 3,800 stocks this year. So we've been talking mostly about the Russell 1000 and Russell 2000, which is the largest 3,000 stocks in the index. But yeah, if you look at the broadest market possible, the broadest index possible for the U.S. equity markets, the Russell 3000E on a net basis added, a significant number of companies, and it is going back to that recovery story. Companies getting more capital in IPOs. Again, going back to IPOs, we do add them on a regular basis, but they were a pretty small part of the story, although much bigger, because last Reconstitution we only added 6 IPOs to the Russell indexes versus more than 50 overall to the Russell 3000E this year.
Yeah, and one thing that I would just to add to that, like I think oftentimes we talk about what are the benefits of indexes and ETFs, and it always comes down to low cost, tax efficiency, and transparency. I think oftentimes our clients forget about the transparency aspect and the beauty of that, because if you think about 20 years ago, right? Historically, we would maybe use an active manager, right? We wouldn't know exactly what they're owning. And so the way that I think about it, the analogy that I like to use with clients is, I think of active management as, do you remember those Jock Jam CDs back in the day, where there'd be a commercial and basically you would pick whatever songs they chose for you, you would get. And so you'd be hoping for Biz Marquis' Just a Friend, but you may get it, you may not, depending on that CD. What I think indexes and ETFs have done is really the Spotify of investing. Right now, you can pick and choose exactly what exposure you want in your portfolio, exactly what songs that you want on your playlist. And depending on your views, you can include or exclude those securities, right? So if you wanted AMC or GameStop, maybe you would use the Russell 2000 Value Index prior to this reconstitution. If you didn't, maybe you'd use the Focused Value Index, which have a quality filter that screen those out. And so I think that oftentimes gets, although our institutional clients love the transparency, and it's why we get phone calls every day prior to these rebounds or before, just so they can get a feel for what changes might happen. I think some of our advisory retail clients maybe take that for granted, but I do think, especially when thinking about the aggregate exposure at your portfolio, the transparency is a huge benefit to portfolio construction.
Maybe directly to you, but which factor do you think investors should look at closest after the reconstruction?
Yeah, so after the reconstruction, to me, I think the question that we're always getting is, does this value rally still have legs? And so when thinking about that, I mentioned it earlier, this is the worst drawdown in history for value. Yes, we've had strong performance since November 9th, but we're still far and away in negative territory for value relative to growth. And so, and that's not to say you should be backing up the trucks into value and you should be significantly overweight. But what we found with most clients is that they're still underweight value. And so to me, I think using products like SVAL, or small cap value, or FOVL, focused value, or even the Russell 1000 value, like IWD, plugging in some of the gaps within a portfolio level, I think are really important. I know FTSE, we here at BlackRock have the tools if you wanted to reach out to see the exposures at your portfolio, to see if you're underweight value or if you're overweight. If you're underweight, we do think it's prudent right now to at least close that gap. If not, maybe make it a little bit overweight within a portfolio.
And another question adding to that also, how is index-based investing, if we stick to that subject, investing, an effective way to gain access to a factor?
Yeah, sure. So, and we've kind of touched on it, but I think the great thing about the index is, again, it's transparent and it has a rule. It's rules based, so it does exactly what it says on the tin, right? So if you wanted to find value exposure, I think oftentimes active managers sometimes drift into growth or into blend. It's not surprising given the drawdown that we've seen. But in my previous life, I used to be a portfolio manager for multi-asset strategies, and I think one of the biggest challenges or one of the biggest frustrations in my time was that if I got the macro call right, which is which at the time was very, very difficult and still is very difficult. And for me, it was rare. But when I did get that macro call right, the most frustrating thing is that the exposure didn't do exactly what I expected, right? So maybe I made the call on growth. I bought a growth manager, and that growth manager really was cheating into value or small caps. Or I bought I made the call right on value, and the value manager was drifting to blend or to growth. And so what I think the beauty of these factor indexes do is, if you want to get precise exposure to that factor, to that exposure, you can do that in a rules-based way and at a pretty low cost based on your provider.
I have one last question. You already mentioned it in the beginning. You talked a little bit about the trends. Maybe from both of you, what do you see? What do you think are the upcoming trends? Where do you see the focus within trends in the future in general? Just to give our audience again the perspective of an expert and our guests in this Perspectives Live, it would be nice to know or have your opinion on that.
Yeah, sure. So I guess I'll just the last trend. I had mentioned value, but I think another one is extending factors beyond the U.S. And so I think one of the other big key insights that we found when reviewing all those advisor portfolios is that almost all clients are underweight international exposure relative to the U.S. Now that's been a positive, right, because of the significant outperformance of the U.S. versus international. But we do think it's probably prudent to maybe pare that back. And so one thing that we're seeing clients starting to do is, hey, maybe you can take those same U.S. views, like your exposure to value, and actually do those same things within the U.S. or within international. And so I know we recently looked at, or launched a product with FTSE on international small cap value ISVL, because we do think that is going to be a big trend within advisor and institutional portfolios, is again extending those factors to international so that you can express those same views across your portfolio.
I would add, I think indexes will continue to grow in terms of importance and interest to investors. I mean, we saw that with the explosion of Memestock mania, and then clients started looking at what are more strategic solutions I should be looking at, not so much tactical. I was just looking at, by the way, the total AUM, the assets benchmarked to the Russell indexes. In 2015, we had 6.6 trillion benchmarked to Russell US index. That's including active and passive funds. But passive was only 825 billion of that. As of 2020, we had $10.6 trillion assets benchmarked, with 1.9 trillion of that passive. So the passive percentage has grown. So not only has the total AUM grown for both active and passive, but the passive percentage has grown over the past 5 years. So I think that will continue to grow, just generally indexes and their importance in the markets, as well as the passive assets growth.
Thank you so much for your insights, and thank you for your time. We're gonna answer all the questions from the audience also as well afterwards, and we'll get back to you, Catherine and Bob. Thank you so much for your time and for joining us, and hopefully see you again soon.
Thanks for having us.
Thanks for everyone who joined, and if you would like to have more information and to learn more about the Russell Reconstitution by scanning the QR code that you see right here in the screen, and feel free to contact us for further information. Hoping to see you soon in another Perspectives Live episode.